Welcome to the Deep Dive. Today, we're digging into your sources to really cut through the noise surrounding mutual funds. It's a term, we all hear it constantly. But figuring out how they work, their strategic value. Well, it can feel like wading through a lot of financial jargon. Our mission today, to clear that up, give you a path forward with some really actionable insights.
Absolutely. And, we want to go a bit deeper than just the basics. We'll look at how mutual funds actually work, the real power behind things like systematic investing, compounding, and crucially, why investing, especially using tools like mutual funds, isn't just, well, nice to have, it's pretty much essential today, particularly when you factor in things like inflation. So yeah, the goal is a clear, strategic understanding for your financial future.
Okay, great. So let's unpack this right from the very beginning. Mutual funds. We hear it everywhere. But what really makes them tick? What makes them such a, well, powerful tool for investors? Feels like there's more to it than just, everyone throwing money in a pot.
Yeah, and what's really interesting is how they solve a big problem for individual investors. I mean, at its core, it is a basket, like you said, where lots of people pool their money. But the real power comes from the professional fund manager. This manager takes that pooled money and strategically invests it. In different assets, stocks, bonds, maybe a mix based on what the fund is trying to achieve. It's objective. So it's like getting instant access to a diversified portfolio, professionally managed, something that would be, frankly, really hard and costly to build yourself. Your sources really point this out. It kind of democratizes sophisticated investing.
Right. So it's not just about avoiding the headache of picking individual stocks yourself. It's more about getting this broad diversification, maybe across dozens, even hundreds of companies or assets, things you likely couldn't access easily on your own. It's a shortcut, almost.
Exactly. A shortcut to being well diversified without drowning in research.
Does that mean you give up all control? I know that's a worry for some people. Handing over the reins.
That's a really common question and a fair one. You do delegate the day-to-day buying and selling, yes, but you absolutely retain control over the big picture. Which fund you choose, you pick based on its goals, its risk level, the fees, things your sources definitely highlight as important.
Okay.
So you're choosing the strategy, the expert,
Well,
not just handing over cash blindly.
Got it. Okay, and speaking of strategies, SIPs. If you spent any time looking into investing, you've definitely heard about SIPs. Why do these get talked about so much? What's the magic there?
Well, SIP just stands for Systematic Investment Plan, and it's essentially a really disciplined way to invest. You put in a fixed amount of money regularly, like say every single month, into the mutual fund you've chosen.
Right, like clockwork.
Exactly. And the benefits are pretty significant. First, it builds financial discipline, which is huge. Second, it helps with something called rupee cost averaging or dollar cost averaging. And third, it really lets you harness the power of compounding over the long haul.
Okay, you mentioned dollar cost averaging and compounding. Let's break those down a bit more. Compounding especially. It sounds a bit like high school math class.
Yeah.
But everyone says its real-world impact is massive for building wealth.
Oh, it absolutely is. So, dollar cost averaging first. Because you invest the same fixed amount each time, you automatically buy more units of the fund when the price is low and fewer units when the price is high.
Okay.
Over time, this averages out your purchase cost. It kind of takes the emotion out of trying to guess the market's highs and lows.
Which is notoriously hard.
Extremely hard, even for pros. And then compounding. Simply put, it's earning returns on your returns. So you invest, say, $100, it earns $10. Now you have $110 working for you. The next time, you're earning returns on the full $110, not just the original $100.
Okay, I see.
It seems small initially, but as your sources show, over many years, especially if you start early, that effect really snowballs. It can dramatically accelerate how your wealth grows.
So it's that consistency, even small amounts, but regularly. That turns into something significant down the line, like a snowball rolling downhill, getting bigger and bigger, which leads to, I think, a really fundamental question a lot of listeners probably have. Why bother investing at all? Why not just, save money in a bank account? Isn't that safe enough?
Yeah, and connecting that to the insights from your sources, the big problem with just saving is inflation. Inflation basically means your money buys less over time, the purchasing power goes down.
Right. Things get more expensive.
Exactly. And the articles you shared gave a great example. Imagine your savings account pays you 4% interest, but inflation is running at, say, 6% that year.
Yeah.
Well, you're actually losing purchasing power. Your money is effectively shrinking by 2% in terms of what it can buy.
So just sitting on cash, even in a savings account, means you could actually be going backwards financially.
Precisely. Passively saving might feel safe, but inflation is silently eroding its value.
So, are mutual funds, especially the ones focused on equities or stocks, are they the answer then to actually beat inflation?
Well, they certainly have the potential to. Equity
Mm,
mutual funds specifically, yeah. Historically, over the long term, they've often provided returns higher than the rate of inflation. This helps you not just keep pace, but actually grow your real wealth, your purchasing power.
okay.
Now, they do come with market risks, especially short-term ups and downs. Let's be clear on that. But your sources consistently point to their long-term potential as a powerful way to combat that inflation drag.
Right. So the big takeaway here for everyone listening, it seems passive saving just isn't going to cut it anymore if you want to secure your financial future. You need active, informed investment. And things like mutual funds, maybe using SIPs, they offer a structured way to do that, to protect and, ideally, really grow your money over time. Okay, so let's just quickly recap the main points from this deep dive. We've seen mutual funds as these professionally managed baskets offering diversification. We've talked about SIPs, that systematic approach using dollar cost averaging, and, importantly, compounding to build wealth. And we've really hit on why investing is crucial to beat inflation, something simple saving often can't do.
Yeah, and if I could offer one piece of takeaway advice, pulling from all the sources, it really boils it down to this. Start small if you need to, but start. Be consistent with it. And maybe most importantly, stay invested for the long term. Don't get spooked by short-term market noise. These aren't just, nice sayings. They're how you actually leverage time and that compounding effect we talked about.